Welcome back. I'm Valerie Fuson with Keller Williams, and this is David Schneider with Advanced Residential Solutions. In the last session, we discussed the impact of the recession on housing, the foreclosure timeline, and the homeowner options. In this session, we're going to go into a little more in-depth review of the short sale and the workout process. Dave, can you explain a little bit about what is a short sale?
Sure. A short sale is simply when a lender accepts less than what's owed on the mortgage balance in the sale of a home.
Okay. And I often get asked a question, well, how can I do that? Because I owe this much money and the bank's not going to accept it, so I can't sell my house.
Well, actually, contrary to that understanding, the banks are actually motivated to accept less than what's owed on the mortgage balance in order to curb their losses or minimize the losses. That's why they've developed and started loss mitigation departments, and now these are very large departments within each bank because their responsibility is to mitigate the loss for the lender. And one of the largest solutions are the loan modification program, which allows the homeowner to remain in the home, as well as the short sale solution, which allows the homeowner to sell their house for less than what they owe and be able to move on with their lives.
Dave, what does the lender take into consideration about whether or not they're going to approve a short sale?
Well, it's important that we make two cases to the lender. The first case is that the home value is less than what's owed on the mortgage balance. And that will be proven through comparative market analysis, appraisals, and valuations. The second case that needs to be made to the lender is an actual financial hardship. The lenders are looking for a long-term hardship situation and not short-term hardship situation. They'd rather keep the homeowner in the house if it is a short-term hardship and bring them current with their mortgage. But for a short sale to go through, the homeowner or the bank is actually seeking a long-term or a permanent hardship as the case, so that as a requirement for the short sale.
Mm-hmm. And that might be maybe someone lost their job, a death in the family.
Yeah. Usually it's job loss, business loss, health issues, when a spouse may have a heart attack or other serious illnesses, death of the spouse, the business loss, even the mortgage product itself can cause the foreclosure. Adjustable rate mortgages in the last few years, when the ARMs were adjusting and their payments were actually going up, and homeowners could no longer afford it because the payments increased by, say, $1,000, and the homeowner just didn't have enough income. Mm-hmm. And in the case in the last few years, or the last couple of years with the recession, homeowners were losing their jobs, or they had a reduction in hours, which has been very common problem with a lot of homeowners that we talk to. And therefore, they could not afford to keep the house, or couldn't afford to continue their payments.
And the other thing is a strategic default. Can you explain that and what impact that'll have on the homeowner?
Well, strategic defaults are not acceptable to the lenders. That is a case where a homeowner accepts the option to stop making payments even though they can still or continue to afford making the payments. And that is something that we're seeing more and more of in the last year. And lenders are taking a very hard stance against strategic defaults and may even pursue homeowners in civil court if they do pursue a strategic default. We do not subscribe to strategic defaults. In fact, when we work with homeowners, we only seek homeowners that have sincere hardship, and it has to be a long-term hardship as well. When we sit down with the homeowner, we'll discuss in detail their hardship and make sure that it is a hardship and it is a long-term hardship, because that is the case that when we get involved with the case and negotiate with the lenders, we're going to spend a lot of time with the financial package to make sure that the financials, which include your bank statements, your tax returns, there's actually a hardship letter involved, but that supports the hardship case. And the hardship letter will actually explain the hardship, and with most homeowners that we work with, they're legitimate.
Okay. And on average, how long does a short sale take?
Short sales take, on average, well, actually it varies. It varies from lender to lender. Short sales could take from 3 months to as long as a year. On average, I think it's somewhere between 4 to 5 months nowadays.
Okay. And I know they're putting in regulations to try to move them a lot quicker, aren't they?
Yes, the HAFA program was set up to streamline the short sale process, and it's had limited success, I believe.
Okay. And does an approved short sale release the homeowner of all loan liabilities?
It depends on the lender. It depends on the loan and product type. Some lenders, as a general policy, will provide full satisfaction of mortgage. Other lenders will not. Other lenders will pursue deficiency as their normal practice. It really boils down to is what their investor guidelines are. In some cases, there is a minimal, what's called a deficiency judgment, where they're actually going to pursue deficiency against the homeowner. Some require that the homeowner sign a promissory note, either at or prior to closing. Others will negotiate with the homeowners and settle for a percentage of the deficiency balance. The deficiency balance is defined as the balance of the mortgage that was not paid off at the short sale closing. So there's usually a balance that still remains outstanding.
Yeah, and talking to homeowners, you know, a lot of them have put a lot of effort into updating their homes and have lost equity in their homes because the homes are less value now. And I've been asked by them, can they get any money out of the short sale?
Nowadays, some lenders will allow some money for moving expenses. Some of the government programs, such as FHA, HAFA, do allow money to be allocated to the homeowner. However, there are cases if there is a junior mortgage involved, sometimes that money is allocated towards the junior mortgage and then the homeowner may not receive it. But in limited cases such as the HAFA, FHA, they do allot money to the homeowner. And usually it's for moving expenses and helping get a fresh start.
Okay. What are some of the advantages of working with an investor?
Well, working with an investor, the investor takes a third-party position in the transaction. On the one hand, the investor is serving as a negotiator for the purchase of the home, because the investor is actually purchasing the home in that case, and so they will be seeking a settlement with the lender. So in the case of working with an investor, the investor is working in their best interests. They want to purchase the property at the fairest value based on the values in the area and appraisals, of course. And also, the investor offers several solutions. So if the investor cannot afford to purchase the property at a price that's acceptable to them, they can also facilitate the sale of the home through the use of a realtor. In fact, most investors work with realtors as they negotiate with the lender on the short sale. They also will keep the property listed with the realtor and seek a backup offer. So in case the investor's offer isn't successful, they can just turn the property over, turn the sale over to an end buyer that's found through the realtor. So it's an important process where each party serves an important role in making sure that the short sale is successful.
Yeah, I know it's really trying to get the investor and the realtor to work together is really helpful for the homeowner to get that property sold as quickly as possible. Absolutely.
The advantage of the investor, when the investor is involved, is it actually shortens the process timeline, because the investor is actually making an offer immediately on the property, starting the negotiations today, whereas if the realtor was not working with an investor, they would actually have to wait until they receive an offer to start that process, and thereby it's causing the buyer to wait an extra 3 to 4 months. Whereas in the process with an investor, the negotiations may have already be 3-4 months into or towards closer to a solution, and so as the buyer, or when the buyer comes along and makes an offer on the property, they may only have to wait between 15 to 45 days.
Yeah.
And so we lose fewer buyers as a result, because obviously it's a very timely process, and time is of the essence.
Right. Yeah, some buyers can't afford to wait 6 or 7 or 8 months.
Absolutely.
So having the investor come in and purchase property is a really good solution.
Absolutely.